And now I'd like to welcome my first guest, Mohamed El-Erian. Mohamed El-Erian is Chief Economic Advisor at Allianz. He's a columnist for Bloomberg View and contributing editor of the Financial Times. He served as chair of the Global Development Council under President Obama and was named one of foreign policy's top global thinkers 4 years in a row. He's the author of 2 New York Times bestsellers, including When Markets Collide, as well as The Only Game in Town: Central Banks, Instability, and Avoiding the Next Collapse. Mohamed, welcome back to the show.
Thank you, David.
You know, recently in Bloomberg.com, you had written that in the 10 years since a global financial crisis damaged many lives and almost tipped the world into a multi-year depression, efforts have been made to strengthen the banking system and reduce its risk of contaminating the real economy. How successful do you think those efforts really are in terms of preventing a future banking collapse like the one we had in 2008?
I think we've been good at playing defense. So we've been good at preempting another crisis.
Okay.
And certainly the banking system itself is safer. Higher capital buffers, better liability management. But we haven't been good at playing offense. We haven't been able, until recently, to unleash the considerable potential of this economy. So good defense, less good offense.
Okay. And when you say playing offense, do you mean that there's still people that are fairly creditworthy out there that simply aren't able to get loans? Is that what you're referring to?
Yes, I think 2 things. One is that the banking system still doesn't serve enough people. And the other one is that to the extent that the risk is there, it has morphed and it has moved. So the banking system has become safer. The risk to financial stability is now in the non-banks. So there's been 2 elements that have operated. But part of it is because we can't over-rely on finance. That was the big mistake made in the run-up to the 2008 global financial crisis. We depended on finance as the engine of growth. That is wrong. There are better engines of growth that are more durable, and that is what we should be investing in. And we are, to a certain extent, doing so now.
Now, you said that the risk to something like the risk to the banks a moment ago doesn't really lie today with the banks. It lies with other institutions or other entities. What do you mean by that?
So part of the strategy coming out of the global financial crisis was to use the central bank to deliver not just financial stability, but macroeconomic outcomes, to deliver higher growth. Now, central banks can't do what's needed. They cannot invest in infrastructure, they cannot invest in people, they cannot deregulate, they cannot improve the fiscal system. The only thing central banks can do is use what's called the financial asset. Another way, manipulate asset prices in order to change behaviors. So what does a central bank do? It lowers interest rates, it puts in more liquidity, hoping that people will take more financial risk, and as they see asset prices go up because there's more risk-taking, they become more confident about the economy. That is not a great way to run a railroad. They had to do it because political polarization precluded other things, but it's not a good way to do it because it decouples finance from the real economy.
It's kind of like a placebo effect, is it not, that in essence the Federal Reserve created by doing that?
Yeah, well, you know, they did get some reaction and growth would have been lower than it would be otherwise. But even Ben Bernanke in 2010, when he announced this shift, said, remember, it comes with, and I quote, benefits, costs, and risks. And the longer you're in this mode, the lower the benefits, the higher the costs and the risks. And I don't think he or anybody else imagined that we would be in this mode for such a long time.
Sure. I mean, we've been here for a decade now, and I agree completely. When we come back, we're going to talk a little bit about the Federal Reserve with you and the economy, and whether you think the Federal Reserve is going to raise interest rates 3 more times, 4 more times, what direction they're going in. So if you stay with us, we'll be right back. And you stay with us also. We have much more here in terms of words of wisdom from Mohamed El-Erian on the income generation. We'll be right back. Right now, it's time to welcome back Mohamed El-Erian. You know, it could have been the same article. In one of your Bloomberg.com articles, you talked about the recent jobs report, and now it's seeming as though there's a little bit more uncertainty in the economy, and with the potential for trade war and everything. How do you think that's going to affect the Federal Reserve's decisions throughout the rest of the year and into next year?
So I still think that the Fed will hike one more time this year, so 3 hikes in total for 2018, okay. And the balance of risk is towards a 4th hike. Why is that? First, the economy is good. It's doing well. We haven't yet felt any meaningful impact from the trade tension. Second, the latest inflation numbers show you that we are at the highest headline rate since 2012 and the highest core rate since January 2017. So the Fed is very close to saying we have met our dual objective, 2% inflation and labor markets. But the problem, David, is what's happening in the rest of the world. Mm-hmm. The rest of the world is not in a good place. It is slowing down. It is losing momentum. So the Fed has to balance these two things. That's why I don't yet buy that we're going to get 4 hikes. I still think we get 3 hikes, but I recognize that the balance of risk is towards 4.
So the question then becomes, here's the Fed taking, a more hawkish approach. Most of the rest of the world is taking a more dovish approach. It's really creating a governor for long-term interest rates, keeping them down. Is that ultimately going to limit what the Federal Reserve can do here without risk of creating a flat yield curve?
So you're absolutely right. The curve is flat. It is as flat as 28 basis points between the 2-year and the 10-year. That's a very small differential for 8 years worth of maturity. So on the surface, there's reasons to worry. Why? Because that in the past has signaled a slowing economy. But let me give you another indicator, David. The difference between our 10-year and the German 2-year. Our 10-year is about 255 basis points above the German. That is very, very high. Mm-hmm. And that explains why we should be less worried about the flat yield curve. What's happening abroad is depressing our market interest rates. Mm-hmm. So at the longer end, you have what are called non-commercial buyers, people who come into our market either because they're pushed into our market. They keep our rates low, but at the shorter end, mm-hmm. you have the impact of the Federal Reserve. So that's why we have a flat yield curve. It is more technical than it is a signal of a slowing economy.
Okay, so you're saying that it's really a symptom of a different problem, not the problem that typically indicates that we're going into a recession, which is a very good point. It's funny, you mentioned the 2 versus the 10. Even the 2-year versus the 30-year government bond in our country has been anywhere between 0.35 and 0.4%, which is utterly ridiculous. That's an extra 28 years of risk for maybe 1/3% interest. It's crazy. I mean, can you remember, when's the last time you could remember the difference between short-term and long-term rates being this narrow?
It goes back a long time, and it did signal a significant economic slowdown. That's why the Fed says we're looking at it, we're monitoring it very closely, but we're not yet worried about it. So it hasn't changed the Fed's intention to hike rates, but they're looking at it.
So it sounds like then, as long as things are happening abroad that's creating a governor on those long-term rates, that all these bond vigilantes out there are going to have to wait a long, long time before they see their bond bubble burst, or at least until Europe starts and the rest of the world starts getting better economic shape. Would that be your take on their spin?
Yes, I think you want to wait for 2 things before you declare a major bear market mm-hmm. in the U.S. bond market. One is that things pick up in the rest of the world, and that 2 central banks in particular, the ECB in Frankfurt and the Bank of Japan in Tokyo, mm-hmm. stop buying massive securities on a regular basis.
Meaning our government bonds.
Yeah, they have what's called quantitative easing programs, which is what we had, but we don't have anymore, whereby every month they buy securities. So they depress the price of their securities mm-hmm. that push people to our securities, which brings our price up and the yields down. So both yields come down. The second element is one that's less talked about, what's known as LDI, liability-driven investment.
And Mohamed, if I can get you hold on for just a minute, we need to take a commercial break. They're talking in my ear. We'll be right back in a minute to finish this conversation. You stay with us too. We're right back here on The Income Generation. We're back here on The Income Generation with Mohamed El-Erian. Now, sorry to cut you off there for a moment. We talked about the two reasons two things that have to happen for long-term interest rates to go up and to create a bursting of the bond bubble, as so many people are erroneously predicting today. One is that a lot of foreign governments would have to stop or slow down the purchasing of our government bonds. And you're about to give me the second one. What is that?
So the second one comes not from the public sector, not from central banks, but from the private sector. And it comes from companies. Because the stock market did so well last year, a lot of companies are in a better position to immunize their liabilities, to match future liabilities on the pension side with more secure income on the asset side. And that's why they are also buying longer dated bonds. So both these sources are what's known as non-commercial buying of the markets, and they keep interest rates low.
Okay. Now, changing subjects for just a second, and I thank you for that. I hadn't actually thought about the second one myself to the extent that you have. Great point. Now, you made a pretty bold statement, and I love you for your optimism and your patriotism and all that, but you said in one of your writings, I can't remember exactly where, but you said that we will win a trade war, and you seem to have said that with confidence. Why is that?
Because we are less dependent on international trade than other countries, including China. So in relative terms, we win this war. It comes at a cost of some absolute damage. And the big question for me, David, is at what point does China realize that they are in the position that Ronald Reagan put the Soviet Union in when he embarked on the military spending race? The US can win the relative war. The question is how long does it take for China to realize that and to respond to what are genuine grievances about intellectual property rights, about joint venture requirements. So there are things there that would suggest that we may end up with still free but fairer trade, but it's a risky time.
Interesting. Economically speaking, the trade war for China could end up being what the Cold War was for Russia. So our audience, the income generation members, those baby boomers who are either retired or kind of on that final descent into retirement, you know, what should they do? What's your best advice for them? You know, I love you because, like myself, you're a fixed income guy. But you're also an equities individual, you know, managing international portfolios in the past and so on, global portfolios. So what would you tell those viewers that are looking at lower yields on fixed income, looking at a stock market that's gone up for over 9 years in running now? What would you say to them?
I would say recognize that we are changing landscapes. You see it already in higher volatility, higher short-term interest rates. Understand that we're entering a world of greater divergence in economic performance and greater dispersion in asset prices. So just first understand that this is a very different landscape than what we've seen in previous years. Otherwise, you're going to be completely unsettled and the risk of a mistake goes up. That's the first critical issue. The second is ask yourself, what mistake can you afford to make and what mistake can you not afford to make? That's really important when the landscape changes. And then thirdly, make sure that you have some dry powder because in this volatility, some good names, strong balance sheet, good business models will get temporarily depressed.
So in the 40 seconds or so we have left, you know, tell us what you think. I've said this recently that the days of buying an S&P 500 index with this trade war are probably not going to be ideal. It almost seems now like individual stock selection if you're going to be in the equity market, where you start to look at certain companies' exports. It almost seems like that's what people have to do if they want to make money in the equities market versus just buying a mutual fund or an index. Your thoughts?
Yes, in capital letters, and that is the outcome of greater dispersion in asset prices.
Gotcha. So it's a different world. It's the new normal, as I think is the phrase that you helped us coin 10 years ago. The new normal, and the new normal is trudging forward. Mohamed, thank you so much for being on our show once again. It's been my pleasure.
Thank you.
All right, stay with us. We'll be right back here with lots more on the income generation.